Firstly, I've been asked, why would countries want to limit their production? Wouldn't they want to just pump out as much oil as possible so they can make as much money as possible? Well, that's not exactly how it works for oil. So how oil works, the more barrels of oil being produced, that equates to more barrels of oil being on the global energy markets, right? So the more barrels of oil in the global energy markets, that means that the producers of oil they get less money per barrel of oil, because when the market is flooded with oil, that inherently makes oil cheaper. That's how this particular commodity works pricing wise. And conversely, let's say there isn't a whole lot of production, there's a lot less barrels of oil on the global energy markets. That makes the barrels of oil existing more in demand. So the energy producers, they can get much more money per barrel of oil. And typically when you think of business, you think of, I want to just sell as much as I can and just rake in as much cash. Well, that's for commodities, that's particularly oil, that's not necessarily the case. There are some times that you can make even more money by selling fewer number of barrels of oil, albeit at a higher price, than you can by selling significantly more quantity-wise barrels of oil, but at a much lower price. So that's the way you should think about it when oil producers or any energy producers discuss either raising or lowering production. Essentially saying, are we going to jack up the prices or lower the prices? That's how it works. Additionally, I want to touch upon the fiscal break-even price, as it's incredibly important, particularly for oil. So energy producers, they depend upon the fiscal break-even price. So what is it? Fiscal break-even is the price per barrel of an oil that a particular oil-producing country needs to break even, to not only be able to balance their budget, but also to cover their spending needs. So think about it. If you're not the United States, you pay all your, like, for example, import bills, and you bring foreign goods into your countries, you're paying for these bills in USD, dollars, and your national currency is not the dollar. So you need to have dollars in the reserves of your central bank to pay for this. So the fiscal break-even sets the amount that not only to cover production costs, but to balance your government's budget, but also to cover all of your spending, paying for all your bills in US dollars. So that's why the fiscal break-even price is important. And just to give you an example, so Saudi Arabia, which they tend to be very conservative on their estimates when budgeting for the upcoming year. Their fiscal break-even is $69 per barrel of oil as of right now. And as of this last week with their budget, they're estimating that the prices in the global energy markets on average throughout 2023 will be 76 USD. And the fact that they're conservative, they do this because they don't want to be super liberal. And by that I mean just just have an overly high unrealistic number, because if they budget for that and it's lower, then their budget's all screwed up, right? They can't pay all their bills. But if they're very conservative and the price is lower, this typically indicates that Saudi Arabia expects the price per barrel of oil to be much higher, despite them having it lower, to be in the safe side for budgetary purposes. So we can estimate, based upon the 76 USD per barrel of oil average for the year 2023, that Saudi is assuming that barrels per oil will be in the $80 to $90 range for next year. So that's just a little recap of fiscal break-even price. Why does that matter? And sort of how production works. You don't necessarily want to produce more barrels of oil per day if you're trying to maximize the amount of money.